Chapter 8 centers on reporting and analyzing the receivables. As you move through this chapter, by the time you are done, you should be able to explain how companies recognize their accounts receivables, describe how companies value their accounts receivables and record their disposition, explain how companies recognize value and disposal of notes receivables, and describe the statement presentation of receivables and the principles of receivables management. The term receivables refers to amounts due from individuals and companies. Receivables are claims that are expected to be collected in cash, and receivables represent one of the company's most liquid assets. Receivables are frequently classified as accounts receivables, which are the amounts that customers owe on accounts. They result from the sale of goods and services. These are often called trade receivables. Are expected to be collected within 30 to 60 days and are usually the most significant type of claim held by the company. There is a written promise or a formal instrument, which is known as the notes receivable. This written promise is evidence of a debt owed to the organization. These are credit instruments that normally require the payment of interest. And then non-trade receivables. Those are other receivables. Those are things like loans to company officers, advances to employees, income taxes refundable, things of those natures. Here we have a basic representation for you to show you kind of like how significant receivables are to different types of organizations. So depending upon the nature of your organization and whether or not you extend credit, because when you allow somebody to have a longer period of time to pay other than the point of sale, credit becomes extended from your organization to your customer. As you can see here, receivables can be 43% of the total assets of an organization. So you can see why managing them, recognizing them, and working within them can be so very important. Receivables are recognized when we have performed our service obligation, when we have completed that performance obligation. So when we have performed the services or we have provided the merchandise, either way, but that is the point in which they begin to exist if the agreement is that it is going to be on account and we will receive payment at a later period of time. There are several things that we can do to encourage prompt payment, even early payments of accounts receivables. And one of those is that we can offer a discount to encourage early payment. So some of you may be in a situation where you have seen a 2/10 and 30 on an invoice. That says that you will give a 2% discount if the customer remits within 10 days. Otherwise, the full amount is due in 30 days. So the seller is giving a discount to encourage their customers to pay earlier. And of course, there might be a return of goods that are found unacceptable, or they were not what the individual was actually intending to order. And sales returns, when the customer returns an item, that will reduce your receivable. We're going to look at those a little bit more here with Jordache Company. On July 1st, they sold merchandise on account to Polo for $1,000 with the terms 2/10 and /30, meaning that they would give to Polo a 2% discount if they remitted payment in 10 days. If not, then the full amount of the invoice would be due in 30. So when we actually sold the $1,000 worth of merchandise, we created an accounts receivable worth $1,000. This says that there's an organization who owes us $1,000. On the other side of the entry, the credit to sales revenue says for sales of $1,000. Now on July 5th, Polo returns merchandise worth $100. So we have this account that's called Sales, Returns, and Allowances, where we will recognize the $100 worth of merchandise that has returned. And we will reduce the accounts receivable by $100. On the 11th, Jordache receives payment from Polo Company for the balance due. Now remember, at this point, the actual balance due is $900. It's $1,000 of the original transaction less $100 returned. They are within the 10-day period, so they're going to receive a 2% discount. You take 900, multiply by 2%, and that's $18. So we will receive cash in the amount of $882. We'll post the sales discount amount that was taken advantage of $18 to the sales discounts account. And we will reduce our accounts receivable account to $0 by crediting it $900. Now, this says that some retailers issue their own credit cards. This is only if it's 100% through the retailer and it's not backed by Visa, Discover, MasterCard, or something along those lines. Sales that are completed by Visa, MasterCard, or that are completed with house cards that are backed by one of the major credit card companies do not create an accounts receivable. Only if it is wholly in-house. So if we purchase $300 worth of clothing on our JCPenney card, we would have an accounts receivable of $300 to the sales revenue of $300. Now, if the term said that at the end of the month, we were to have a 1.5% charge added to whatever our balances were, so in essence, a interest charge, then we would take the $300 and multiply it by 1.5% for $4.50. We would post that to the accounts receivable accounts, and then we would post to interest revenue. Go ahead and pause here and take a look at this anatomy of a fraud, and then restart the video when you are ready. We're going to walk through this Wilton and Bates illustration. So Wilton sold merchandise on account to Bates for $50,000 with the terms 315 net 45. This means that they will provide a 3% discount if they receive payment within 15 days. Otherwise, the entire amount due is due within 45 days. On May 4th, Bates returns merchandise with a sales price of $2,000. On May 16th, Wilton receives payment from Bates for the balance due. So we're going to prepare the journal entry to record the May transactions, ignoring the cost of goods sold entries, so we're only looking at the sales side. We would have accounts receivable of $50,000 offset by our sales revenue for the point of sale. Then we would recognize a reduction in our sales of $2,000 and a reduction to our accounts receivable of $2,000 for the returned merchandise on May 4th. This brings our accounts receivable account to $48,000. And 3% on that is $1,440, giving us cash remitted on the 16th of $46,560. We would recognize the discount taken advantage of. We would close out the accounts receivable balance of $48,000. Now, there are really two pretty substantial issues. Not only is it recognizing the accounts receivable, which is what we have done, but the second part of this is actually valuing the accounts receivable, because once we go into this situation of extending credit, we create a level of risk on whether or not we will actually collect that credit. And we will talk about valuing our accounts receivables in the next video.